It's going to happen, and it's going to happen with you or without you. And if you're not on the train, it's without you. And it's a life-changing amount of wealth that can be created by picking these companies. President Trump has come in with a clap of thunder.
Oh, yeah.
The big, beautiful bill, though, passed by Congress. It's in law. It's happening.
Remember the tweet that came out, today is a great day to get rich. Something has to power these data centers, which should increase the demand for energy dramatically.
If you want to be competitive in the AI space, in the AI industrial revolution, then you have to have low energy prices. And so it's essential for the US to get that across the line. The average price for a car in America just tipped over $50,000 for the first time in history. Yeah.
That's crazy, isn't it?
Which again is a big psychological barrier. So everywhere that's happened, a lot of that is due to the post-COVID economic stimulus. If you take a company, for example, Netflix, the valuation on it by the yardstick used by traditional investors, it's just overvalued, yet it's delivering. It's a company over 4 years that's gone from $180 a share to $1,300 a share.
If inflation starts to get out of hand, what do we then see? What are the catalysts for that?
That's a big game changer, I think, for our overall outlook, which... If you're serious about making your money work harder, getting a gauge on where we see the US economy is extremely important. Why? Because it drives the rest of the world. In this episode, Mitch and I are going to explore our outlook for 2026. There are three core aspects to this. One of them is inflation, one of them is interest rates, and the third one may just surprise you. Make sure you check this episode out. And most importantly, don't take notes. Make sure you take action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitch Olarenshaw.
Good to be here, Mr. B. Our best part of the year is the start of the year because we've got a clean slate. And today I really want to bounce some ideas around our US economic outlook for 2026. We do this each and every year, and I think you'll find some gems of gold in here as we go through our analysis.
Look, big topic and so pivotal, and you think, well, we're in Australia for the large part for our listeners. Why the US? Well, it's the biggest economy in the world, biggest stock market in the world. It's a driver for virtually everything we do from a trading and investing perspective. So having a bead on it is essential. And, I think we did a reasonable call on it last year, and let's hope we can back that up with this year.
That's the thing. I mean, for our listeners out there, we're going to try and condense what is a mammoth task into a 30 or 40 minute podcast. There is so much information out there. So I hope we could streamline it for the listeners and we can get a couple of different outcomes.
If I start to weave, pull me in.
Oh, yeah. I've got the reins ready. Don't you worry.
No, it's enormous. And there are so many alleys that you can go down. And let's start with last year. I mean, we were pretty bullish US equity markets last year, and obviously, they've performed extremely well, even though, obviously we're recording this at the back end of 2025, there's a little bit of a sell-off there, at the back end of November, but, is that a storm in a teacup as we move into a more secular bull market in 2026, which is what we will cover today?
Absolutely. Well, a couple of key points in 2025, which is worth noting because it's really the tailwind or the headwind for that matter for this year in 2026. New president, number 47, coming in, making policy changes. Tariffs, of course. We've then got rate cuts, which we've had a couple of in the US that start in the back end of the year, and plus a whole different raft of geopolitical issues, government shutdowns. It's a big year, right?
It has been, and look, there's no question about it. President Trump has come in with a clap of thunder.
Oh yeah,
and some of it's been done through the legislative process. The big beautiful bill, as it was called, was passed through, and a lot of the work that's been done has been by executive order, which is a more direct way for him to exert his authority as president. The challenge with that, of course, none of that stuff is locked in and can be rolled back by incoming administrations. The big beautiful bill, though, passed by Congress, it's in law, it's happening. So that was a massive thing. And the tariffs that we saw way back in
March, April,
that seems like a lifetime ago.
Yeah,
and
old news now.
It is, and the end is now. That's it. He's tariffing everything to death, and the reality is the market put on close to 50-60% after that.
Still remember the tweet that came out, today is a great day to get rich, which was the absolute ding dong low for the market.
Buying signal if I've ever seen one. And it's interesting to see how the net effect of those tariffs have really gone on in terms of net foreign direct investment into the US. I think, Toyota are opening four plants in the US. There's billions and billions of dollars of investment now coming in, which was the goal of that. And I guess a leveling, so to speak, of the playing field, which will determine where we go with our outlook. Obviously, the flip side of it is that tariffs potentially can make things more expensive too, which we've seen some hint of too. So.
Let's start with that. So 2026, if we look at probably the main pillar in economics terms would have to be inflation, I would argue, because monetary policy all depends on inflation for the most part. So let's go through a couple of scenarios. If you'll humor me here, AB, let's almost run with like an if, then, because type scenario where we can go through a couple of different outcomes. So if inflation starts to get out of hand, therefore interest rates go up, what do we then see? What are the catalysts for that?
Yeah, I mean, that's a big game changer, I think, for our overall outlook, which obviously stay with us. We'll be giving our equities outlook towards the back end of this. If we see a real shift and we do start to see inflation moving higher, what we'll likely see, obviously, is number one, no further cuts to interest rates. In fact, you then run the risk of the opposite happening.
Yep.
Central bankers don't particularly like that, where you're in trend one and then it goes in a whipsaw to trend two. They tend to be much more staid and slower moving. That said, within the Federal Reserve, we've got a new chairman that'll be taking the reins, I think, in June of next year, after Chairman Jerome Powell steps down at the end of May.
Sad. He's been a good central bank governor.
Look, I think he has too. Is his ability to communicate with markets, particularly, I think
really
it's been
good.
peerless. It's been very, very clear, very transparent, and also there's been a little bit of political pressure that he's been under to try and cut rates further, but the economic data points haven't aligned, and he's stuck to his guns. There's also the value, I suppose, everyone talks of Jerome Powell when they think of the Fed, but there is a committee there, and that committee has actually been quite diverse in terms of its view on what needs to happen. We're looking toward the back end of the year, just before Christmas, of the possibility, noting, we're obviously recording before then, of a further rate cut going into the Christmas timeframe. Which probably wasn't expected a month or two ago. So, the committee themselves, they're coming up with views and opinions, and it's not just the chair.
So let's go through inflation a little bit more. If inflation was to get out of hand this year in 2026, what would be the main reasons for it? I think we should explore. So there's probably three that spring to my mind. One would have to be energy and capital expenditure, and the third one would have to be tariffs, obviously. So let's start with energy and capex, if we can.
Look, I think that those two are absolutely, crucial within the big scheme of things. Energy costs are a tax on everybody within an economy. And if you think of higher fuel prices, for example, everything is more expensive. It costs you more to fuel your car, so it's inadvertently a tax. It costs you more to buy your groceries because they're getting transported around the country in trucks or flying or trains or whatever it might be. Air conditioning to keep your fresh produce. Everything, by being more expensive, ultimately gets passed on to the consumer. So I think energy is such a crucial step in America's goal of having more affordable energy, and that'll lead into things we'll talk about further, like AI, but also the actual impact it has within the economy as a deflationary measure. So, the US has cranked up its oil production quite significantly, to the point now where, if you look in, for example, in Texas with fracking industry, you're starting to have a wastewater problem now, where there's so much water going in the ground because so much oil is being pumped out. You've now got a wastewater problem that you've got to handle, and that's a very different conversation to be having. But geopolitically, President Trump's expressed, some strong actions in peacekeeping around the world. Some would argue that he was snubbed for his Nobel Prize nomination or non-nomination, when you consider the sort of deal between Vietnam and Thailand, India, Pakistan. Obviously, the peace ceasefire, at least in the Middle East, with Israel and Hamas and Gaza, and his attention's turned quite extensively now to try and finish the job in terms of getting Russia and the Ukraine to sit down. And this is really, really important from an energy perspective, because Russia's been exporting its oil, albeit through China, and the tariffs and the punitive tariffs that the Trump administration have used on countries like India, for example, is to say, listen, play ball, do not be buying your energy from Russia. There are sanctions against it. We can't let that happen. Toe the line, or you're going to get smashed with some fairly strong economic tariffs, and that's done the job of creating this oversupply of Russian oil. There's tankers galore floating around the ocean at the moment, full of Russian oil, looking for a market to sell it in. OPEC have already increased their production going into the back end of this year, and they've committed to doing that in the early part of next year. So everything is aligned there. If you get peace between, or a ceasefire, or some form of a cessation of combat between Russia and the Ukraine, and Russia is legitimately then able to export energy, that's going to go a long way to reducing energy costs, which is a big thing on the inflation side. The alternative to that, sorry for being a bit deep on geopolitics, it's not something I have any interest in whatsoever, as you know.
It's under range already, don't worry.
Yeah. You've also got a US carrier group sitting off the coast of Venezuela, which is also one of the world's largest oil producers. So the US needs more energy from somewhere for multiple reasons, lower energy prices, and also in order to be able to win the war on in AI, which is crucial. So if we see all of that come together and we see lower energy prices, it's disinflationary. That's great news for everybody. If that doesn't happen and we see oil prices grind back higher, that could be potentially a problem.
Yeah, the alternative view as well, of course, that I'll add to that is that huge capital expenditure. So we talk about the whole AI boom that's going on right now. Massive amount of data centers being built. Something has to power these data centers, which should increase the demand for energy dramatically.
That's
I would
right.
argue.
You've got to, China have had a jump start on the rest of the world with the volume of power stations using a whole raft of things from coal to nuclear to enable them to have very, very cheap energy, which is giving them a jump start in that ability. And just to backpedal for anyone that's not familiar with this, so the technology behind AI are really, really sophisticated chips, Nvidia being the primary producer of these. And they are massively, massively energy intensive in terms of what they need. So if you want to be competitive in the AI space, in the AI industrial revolution that's we've started, we're not finished with it yet in my mind, then you have to have low energy prices. And so it's essential for the US to get that across the line. It has to happen, which I think is why you're seeing, the initiatives with Russia and the Ukraine, possibly whatever's going to go on in Venezuela down the line. And to a different extent, if you look at the recent deal between Saudi Arabia and the US from a defense contracting basis and selling of fighter jets, which happened to, by coincidence, line up with when OPEC chose to increase their productivity. There's a lot of things at play in that geopolitics.
Yeah. Interesting. Okay. So...
And the last one on there was tariffs.
Yes, correct.
In terms of, in terms of what they can do. And the tariffs, largely, we haven't seen any much inflationary pressure come from.
Nothing anywhere near as much as what we expected and feared, which is really the reason for the sell-off that we had initially, right?
That's right.
It would cause huge inflation.
And a lot of companies, some of the talk is that new products and components they've got to buy will be hit with tariffs, so the cost of manufacturing is going to increase. So they've just been running down supply that they've already had. But I don't know that many tech companies keep that much supply of stuff to get through, what's effectively nearly 8 months of production.
Yeah, March was when these came out, right? It's a while since then.
So we haven't seen it flow through. The earnings growth is there for these companies, and we haven't seen major price changes. But the notion of the tariffs has been punitive in some areas to get a better trade deal for the US, which they've got in a lot of different countries, which has been good for the US economy. And it's seen that foreign investment come in. Where maybe some of the inflation issues sit, like food is a big one going into the election. President Trump on the campaign trail said we want to make it cheaper for people to be able to get by. We're just out from Thanksgiving, and if you look at commentary out of companies like Walmart, for example, and other commentary within the market, this year the cost of a Thanksgiving dinner is actually the lowest it's been for about 2 or 3 years.
Interesting. Okay.
So there are some things that have happened in that space, yet there are still very, very stubborn areas in the food space, and there's certainly plenty others where inflation remains stubbornly high. Beef is an example. Coffee is another one. Beef, I think I know we're getting very granular with this, but I think it's important for people to understand that, the tariffs have caused inflation, and that's simply not the case. The reason why food, and particularly beef, is so expensive in the US is rather like we did in Australia, the best part of 12 years ago, have a really, really severe drought. They've gone through their own drought period where many ranchers have reduced their herd size because it's been drier. And as a consequence, you've got a supply and demand imbalance. The US is the world's fourth in terms of meat consumption. I think it consumes 123 kilos or 130 kilos of beef per person, which puts it at number 3, third only to Tonga, interestingly enough, but a trivia.
Really?
Nice. So, they are a big beef consumer. And that then is a very isolated thing that's supply side related. But what we can draw out of that are impacts across the broader American workforce. And we'll talk more to this, I'm sure, as we go on. For a strong economy, you've got to have thriving at all levels, not just the big end of town. And we'll talk about how that end of town has gone shortly. If we look at, say, the meat industry in the US, like there's Tyson Foods, which are probably one of the bigger players in that space, and there are a couple of others, but Tyson Foods are the really, really big player there, and Cargill's the other one. So they've just shut down their abattoir in Nebraska, which is in the middle of one of the meatpacking areas, which is a big production facility. They're working on one shift, not two a day in Amarillo. So that's a reflection. So you've got layoffs at that very blue collar manual working level, which is not good for grassroots America. And it's not because of tariffs and it's not because of tax. It's because of supply and demand imbalance with that. So that's a little quirky niche. Sweet potatoes are also rather expensive in America if you want a bit of extra sugar.
There you go, okay.
So, there are some issues within the foodstuffs place, but by and large, price creep has happened on a global basis. The average price for a car in America just tipped over $50,000 for the first time in history. Yeah.
That's crazy, isn't it? $50,000 US.
Yeah, which, you'd always think, cars pretty cheap over there, which they always were. And now that's just crept over, which again is a big psychological barrier. So everywhere that's happened, a lot of that is due to the post-COVID economic stimulus where there's just money being printed everywhere, chasing fewer resources. So that's an interesting one.
Interesting. Okay, so let's get further down the line. So
let's get back off the weave and onto
let's
the
get back off the weave. So inflation picks up due to the reasons that we've just explored. Interest rates either hold or potentially change course and go up. What do we then see out of the economy? Well, we would expect to see a slowdown, right? Because if inflation's running hot, that means interest rates have to go up to slow things down, if that's correct.
It is the ramifications of that are that you're going to have areas with the economy that continue to run hot, like AI, which I'm sure we'll talk further about, and data centers and all of that kind of thing. But rising interest rates, hit potentially home buyers, less so in the US because people typically have fixed rates. 30-year fix is the standard there. You've started to see an increase in housing approvals and housing starts in the US, which is a really important green shoot at that blue collar worker level. And as we know from our own experience here in Australia, a strong housing sector is great for the economy because it boosts literally everything: supply chains, employment, consumption, ute sales, tool sales, food, everything. It really spills across. So that's an area, if we start to see a shift back up in interest rates, you might see a handbrake put on, and it's taken an awful long time to get that nudged forward and moving it there. And typically you would see higher interest rates when your economy is booming, but if it's inflationary pressure that's coming from something that's a non-booming reason, like higher energy prices, that's a problem.
Yeah,
and that could stall economic growth quite considerably because businesses then are starved of finance. They don't want to borrow to expand, and they're in a big capex phase right now.
Yeah,
so you see an immediate stop to that capital expenditure, which has been one of the biggest drivers for growth in the US.
And I'm guessing then you see layoffs as well, right?
Furloughing, money, and that's the start of a not so good cycle. So that's something we obviously don't want to see, and it's not something we particularly envisage either.
Interesting. Well, let's look at the opposing example, shall we? So let's go down the pathway where if inflation remains where it's at, or maybe keeps to drop away, interest rates remain where they are, or we get more rate cuts.
Yep.
What are the catalysts? What do we then see from there?
Look, I think you've got a very strong employment market in the US right now. I mean, we've seen unemployment is about 4.2%, which to all intents
pretty much full employment, right?
What'll be interesting is to see what if they backfill since the shutdown, the employment data and the economic data points.
Isn't that interesting? Just a point I'd like to bring up too, as I know we were chatting about this morning. Throughout that government shutdown, we didn't really see any economic data come out. So really, the only thing we got was CPI. So PPI's missed, PCE, housing starts, all the rest of it. It's funny, the market actually rallied all throughout that government shutdown for the most part because there was almost nothing to really derail anything. There was no uncertainty. And then as soon as it ended, well, that was the start of our brief sell-off. Interesting, isn't it?
It's interesting. Kind of supports
chicken or the egg, right?
Supports my view of government, but let's
just get rid of government, landed the free, game on.
Well, a bloated government for sure. I think that's something that again the administration is looking to put right. But it'd be interesting to see. So employment has been pretty strong there, and if we see we can afford to see a little bit of a tick up in unemployment from where it is. Yep. And I think it's important to also provide a little bit of contextual framework to this in that in the world post the pandemic, a lot of companies, there was a talent shortage. They went on a recruitment bonanza, and this could be just a little bit of the trimming of that over hire that perhaps happened through there. Equally, on the other side of the coin, a lot of the layoffs, it's AI. AI hasn't really got a driving seat yet. It's coming, and there may well be layoffs that come in that sort of space. But that's on the tech side. What I spoke to earlier with companies like Tyson Foods with the abattoir closure, that's at the most grassroots, like blue collar level. And you've got to have, for a healthy economy, you've got to have employment across all of those sectors. So as we start to see the benefit of maybe some of the new plant and factories being open, not in the AI space, but say, for example, I mentioned previously Toyota, if you start opening a car plant, the recruitment and the job creation that comes from that probably will offset some of the job losses you've seen elsewhere. And so where do we go when it comes to, say, inflation stays roughly where it is, or we see a couple of interest rate cuts along the way? And I think we've got one coming for the end of this year. For
about a 70% probability now priced in December. And that's only because of recent comments out of the Fed, which would be quite interesting.
And maybe tentatively, possibly something in the early part of next year.
Maybe.
Noting that there's the transition of Powell out and the new Fed chair in.
47 does want lower rates.
And that opening up of capital markets prompts the ability for businesses to borrow, to grow. And that can be a very, very strong economic stimulus that is part of the whole mega philosophy of let's get a stronger domestic economy.
So bigger capex, right? If the cost of borrowing is less, then you're encouraged to spend more,
correct.
right?
And also as costs come down, you get more transactions in the housing space. Again, a lot of American mortgages are 30-year fixed. They learned a lot from the GFC. We didn't. And so people on a 30-year fixed, and while interest rates have been higher, the cost of moving and that downsizing, for example, we go, well, I've got to go from an interest rate that's fixed at 2 to refinancing at 4. Why would I do that? I'll just stay in the bigger house I don't need. So you start to get transactions there. And when you have a healthy property market, not just new starts, but also a secondary market, again, that's great for everything. You think about Home Depot and places like that. People buy stuff for their new home. It's a very, very stimulatory factor. So I think those lower rates would be welcome to see. Flip side, get a weaker US dollar. Is that such a bad thing as the US is trying to push into the export space further and further? Probably not, because it makes US manufacturing, significantly more competitive. And with tariffs, and you're not importing as much, your risk of imported inflation is slightly diminished too. So if we go down that pathway of slightly lower interest rates, that could well be a catalyst for really, really strong growth for the US.
100%. It's interesting. There's a couple of different factors I want to add into the mix here as well. And I mean, that is a great summary on either side as well. What about AI and productivity? How does that factor into all of this? We speak about this all the time, so I want to hear your thoughts.
Yeah, look, I mean, it's the big misnomer, isn't it? And I've had some very, very interesting conversations outside of the professional lane, I suppose, recently, most noted around Nvidia and its reporting last week.
Stellar earnings once again.
And a lot of people just simply don't want to believe that the sun rises in the east. It's like, no, not possible. Oh, it's all going to come down. It's a house of cards. It's Enron 2 or whatever the commentary may be. This is a company that is under starters orders, crouched, waiting for the firing pistol to go to create and dominate a sector. We don't even know where it's going to go.
Yeah.
In terms of the scale and change there.
The whole market was strong too. S&P earnings growth was 17% the most recent earnings season. The expectations was around 8%, so it's more than double what we thought.
Yep. Look, it's there, it's happening, and there are going to be winners and losers in there. If you're a pretender, it ain't going to happen. And if you're the real deal, and if you're a pretender, you might get wrapped up and sucked in with the vortex, just like the .com boom and bust, which a lot of people have compared this to as it stands right now. And if you're a pretender, you're going to get washed out and left in the vapor trail behind this. But for the companies that are at the vanguard of this, it literally hasn't even started yet what they're looking to do. And you listen to people like Musk, for example, which you simply have to listen to. You can be pretty dumb and still become a millionaire, but you don't get to become a billionaire, if not soon to be a trillionaire, by being stupid.
No.
And look at the whole genesis of what he's been able to do. And it's worth the sidebar on this because there's so much hype on this. And I think it's important to step behind the curtain and understand these people, whether it's Jensen, whether it's Elon, whether it's other people, that look at what Google have just done with their latest machination of their search engine, and even Apple now are coming to the table with their upgraded technology for AI on their products. the thought pattern behind these mere mortals like myself, you're just in awe of how they see this. So I listened to an interview with him fairly recently, it's Musk. So why do you buy Twitter? I believe in freedom of speech, but you paid 40 odd billion for something and it dropped down to 16 billion and the advertisers all pulled their revenue and, you had egg on your face. And he said, I've never had egg on my face. And I told people that invested with me, if you've invested with me, you've never lost money. So what happened? We merged it with XAI. It's now capitalized at about 130 billion. So they've tripled the investment that they put in.
Not a bad play, yeah.
And so if you look at what we're doing with Grok, which is his AI model, the biggest challenge with AI, as we all know, and people have tried to use things like ChatGPT for investing, it doesn't work because it's garbage in, garbage out. You've got to have better input. He's gone, look, we wanted to make sure that the learning model that Grok had was more even than what you scrape off the internet, which is typically a little bit biased. With Twitter and having, or X should I say, and that it provides a more balanced view where both sides are free to give their view without it being censored. We have around 100 million posts a day, just in English plus other languages, that we can scrape and use that as our input for Grok based on it being a more balanced conversation, and therefore the less garbage going in, better quality output that's coming out of Grok with the stuff it's doing. And he was comparing it to Wikipedia, for example, which for so many people is their go-to for information, yet it's so technically inaccurate. And he said, well, we're going to put it, and they've taken it down at the moment, the scorecard, to show how accurate what they're putting out is in terms of facts and fact checking versus what's on Wikipedia that's just accepted as being gospel.
Wouldn't it? Because anyone can edit the Wikipedia, right?
Yeah, it's staggering what you look at. And you take a step back from that and go, okay, so you bought a company for $40 billion 3 years in advance, knowing that you would want some form of data input to power your AI technology so that the growth curve that it could be on is steeper and more accurate than anyone else's. How do you even think about that? And this is what these people that are driving the narrow sector of that economy are doing. They're creating the future in advance. And it may not be something that you agree with. It may not be something that you trust, may not be something that you like, but that's irrelevant. It's going to happen, and it's going to happen with you or without you. And if you're not on the train, it's without you. And it's a life-changing amount of wealth that can be created by picking these companies. They won't all do it. There'll be the pretenders that fall away by the wayside. And then those ones that are at the epicenter of driving that future, it's just going to continue to drive growth across the economy, the company, and for any investors in that.
Interesting. So better productivity, better GDP growth for the US next year, or this year coming rather, I should say?
Productivity is challenging because, if you think about factories, the US went out of being the manufacturer bucket for the world was in Asia. Trying to bring that back and convince people that working on a production line is, what you want to be doing. That's a tough sell. But if it's better than what the alternative, people will take that into account. And if you can create a work environment that's got technology supporting your employees in it, you do get productivity growth that then sits there. But that's going to be a big challenge, is retooling people. You can program computers, but reprogramming people, as we all know, is quite challenging.
Interesting. Last but not least, before we wrap up, AB, because this has been an awesome summary, I want to talk about earnings growth versus valuation. And obviously that is more stocks market specific, but it flows on from the economic circumstances that we have available to us. A lot of people are concerned that the market is overvalued. And you look at the S&P 500, it sits at about 23 times its earnings. Long-term average is about 16 or 17. So traditionally speaking, on 10 years, it's overvalued. My question to you and to our audience at large, how many of the companies that we talk about every single podcast this year or last year were around 10 years ago?
Well, that's right. These are companies that didn't even exist.
Yeah, Nvidia wasn't a thing 10 years ago.
So again, these are companies that are driving the future very, very quickly. And if you compare them to the performance of stalwarts, if you had a conversation with an investor, 20 years ago, or 30 years ago, you'd have GE in there, you'd have Merrill Lynch, which is now obviously part of Bank of America. We've got to have American Airlines, we've got to have this, we've got to have that. A lot of those companies have been absolute dogs in terms of their overall performance within markets, and new things come along. And that's the wonderful thing about markets. You have to be open-minded and embrace the future. Because markets historically have been valued at X, doesn't mean to say they're going to be valued that way into the future. If you take a company like, for example, Netflix, which is on a stratospheric price earnings ratio because it doesn't pay dividends, it reinvests everything it does. Yet it's a company over 4 years that's gone from $180 a share to $1,300 a share.
Just had a split too, by the way. You can trade it now. It's far more inexpensive.
There you go. So just had a stock split in there to open the door for more people to get in on
it.
it.
It's like $130 a unit.
But the valuation on it by the yardstick used by traditional investors, it's just, you can't invest in it. It's overvalued, yet it's delivering. And so I think, it's very, very important to understand that, when you drive a car, you're looking through the windscreen at what you're moving towards, and we're moving towards things at pace. And sure, it's good to glance in the rearview mirror as a point of reference, but you can't drive a car looking in the rearview mirror. You'll rear end someone or you'll crash. Looking at valuations from the past were based on what the past was. There wasn't AI in the past. There weren't data centers in the past. There weren't all of these things that are coming along that are revolutionizing the industrial world that we're in, robotics and rare earths and all of these different things. They were nothing to do with the past. So using a model from the past, where I grew up, is very, very challenging in today's markets. And I think this is why so many of the, how can I put this? The more traditional investment houses have underperformed the market significantly because of their refusal or stubbornness to adopt their model to embrace where the future really sits.
That's it.
And there are plenty of examples. I won't name names, but there are plenty of examples of big investment firms that have just not bought into the story, again, oh no, it's all smoke and mirrors, only to discover that it's cost their investors, billions. So I guess, we're for the future. What are the sectors we like the look of? We talked about obviously tech. What else have we got in there?
I think industrials might be worth a look. Obviously, we've spoken about energy as well, even utilities. Industrials was really good in 2025. Industrials did quite well, along with the banking industry or financials. But I think we've spoken a lot about utilities for 2026. What do you think?
Absolutely. I mean, if you've got an industry that needs power on steroids, you have to get them that power, and that does leave utilities, which are an incredibly dull sector that often gets glossed over, and it's certainly been an area of massive underinvestment over the last probably several decades now. Could have its time in the sun. And I think these changes in interest rates that we've seen and potentially have coming down the line have probably messed around a little bit with the timing of this market cycle, so that the late cycle stuff didn't actually come through until now, and it's not really late cycle, it's the start of the next cycle. So I think utilities definitely are an area that will be well worth a look, and obviously, as we've discussed, rare earths and everything that goes into that, robotics, magnetics, and the AI space, because that's where the future really sits. Yeah,
financials would be an interesting one. I think that's going to largely depend around inflation and interest rates for financial stocks.
Well, you look at the business lending going on, in the credit markets right now. The financials are at the epicenter of that, not just in terms of retail banking, but in terms of the investment banking side. And they can be bellwether and be reasonably insulated. I think, again, to reiterate my personal view of the world, and I say this from a moral perspective, we all want to live in a good society where there's opportunity for everybody. And, in the US in particular, we've seen the consumer spending, particularly at the bigger end of town, the high net worth area of town, has been very, very strong, and that's largely because they own real assets that have done well. Property, stock market, they've done very, very well, and they've made money, they're spending it. Seeing that trickle down, and it's not because of tax cuts, it's that opportunity of different types of jobs for people at that blue collar level to be gainfully employed, to have optimism and a better prospect for the future, I think is something that's also very, very important. And if we see that, I think, earnings growth, I think 17% it might sound aggressive compared to history, but it's something that's probably consistent with
what they're delivering.
And it's consistent with what the economy's got on offer. And I think a target for the S&P in the order of 7,900 for the end of the year is not entirely out of the question. I don't think it'd be smooth sailing getting there. I think it might have a slower start to the year and a stronger finish. But again, that comes down to things like energy, inflation, and interest rates. And if they move in the right direction with lower energy, lower interest rates, and inflation really being offset by that lower energy cost, I think we could have another absolute bumper year across the US stock market. And I sincerely hope that all our clients and anyone listening to this get to participate in that and take the opportunity that's there for them and their family, because it's intergenerational.
Absolutely. AB, great analysis, and thank you very much for the insight today.
Anytime, my pleasure. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.